Thank you for your time. It's great to see quite a few of our clients here as well, so I appreciate that. I've got to say, this photo always reminds me when I was younger. I used to compete in ultra-marathon running races all around the world. Compete's a pretty strong word because it was more about participation, but I used to love running up these high peaks and down to these deep, deep valleys and beyond, sometimes as high as 3,000 metres up and then back to sea level again. Today, a little bit older and a lot wiser, I prefer now to just jog through these rolling hills, nice and slowly, nice and carefully. Now, the reason why I brought this up is that if you invest in a good alternative investment approach and sit it alongside your equities exposure, this is the type of returns you should be able to get. You may not get those big peaks of the equity market, but most importantly, you don't get those deep, deep valleys that we're all experiencing in the equity markets this year. And if you choose your alternatives wisely and listen to what Rebecca mentioned, at the end of the day, at the end of the journey, you end up in exactly the same place, but with much lower volatility. So the journey itself is much more enjoyable. So today I'll talk about the Firetrail Absolute Return Fund, which we think is one of those wise alternatives. I'll touch on three areas. Firstly, the risks are elevated right across the markets. We don't need too much discussion there. Secondly, if you are looking to supplement your equities exposure, choose a fund that has low or no correlation to those traditional asset classes. Choose a fund that can provide significant downside protection through those major market dislocations. And then finally, part of the Firetrail Absolute Return Fund, both managing risk and adding alpha, is to the ability and capability to short stocks. But shorting gets a really bad rap, so I'll talk about sort of, if you short correctly, it's a really good and consistent way to add alpha and also to manage risk within the portfolio. But we do believe now is the time to consider an allocation towards alternatives. Now, risks are elevated right across the market. I don't need to show you 46 slides to get my point across. I can really just show you the one, which is effectively US inflation, peaking at around 9% and more than double the previous peak over the past decade. And right now we have two camps in the inflation basket. One camp saying it's transitory, we've hit 9%, that's the peak, the Fed has that under control, and we're back to more normal levels of inflation within the next 6 to 12 months. The second group, which Firetrail are firmly in, is this might have peaked, the inflation might have peaked, but the Fed hasn't got it under control at this point in time, and inflation is likely to be here for quite a bit longer. And it's not just a US-centric experience. If you look at the Eurozone, the CPI there, print last week was 7.5%. Australia, again last week, was 5%. Australia will probably hit 6.5% before it starts to come back down again. But it is this red-hot inflation is forcing central banks around the world, but in particular the Fed's hand. And markets are reacting clearly as a result of that. We have the US 10-year Treasury yield here, hit 3% just last week, around 2.8% today. And our concern is at this early stage, it's the consumer that is wearing the brunt of these higher rates in the form of higher mortgage rates. 30-year mortgage rates in the US have almost doubled now to around 5%. And our concern at Firetrail is does that lead to a significant dent in consumer confidence, which will result to less demand for goods and services, and a real risk, about a 30% risk of a recession sometime in early 2023 for the US. But bond yields are clearly reacting sharply to inflation. And finally, so is the equity market. And it makes sense when you think about it. You've got higher inflation, higher rates. You've got the Fed tightening in a weakening economy. So of course, we're going to have higher volatility in terms of the equity market. And then you add the 4 Cs out there at the moment, the China zero COVID policy. You've got the crisis in Ukraine. You've got the consumer headwinds we're all experiencing. And clearly, we've got supply chain issues that seem to be here for quite a bit longer. So the volatility or the risk profile within equities is here to stay for quite a bit longer, we believe. Now, ourselves as equity investors and long-short investors at Firetrail, we need to use all the tools that are available to us to manage those risks on behalf of our clients. From our long-only funds, the small company funds, the high conviction fund, the new S3 Global Opportunities Fund, we do that a number of ways. Firstly, by making sure we're highly active, making sure we've got a good mix of both value and growth companies, so we're not hostage to one style or the other. Making sure most of the risk is idiosyncratic or stock specific, and then clearly we need to be very flexible. But clearly the other way is to actually invest in an alternative investment product alongside your equities portfolio. And that's what I'll talk about right now. We believe at Firetrail, very similar to what Rebecca was saying, that You need a fund, if you are going to invest in an alternative, you need a fund that has either low or preferably no correlation to those traditional benchmarks. You need to find a fund that has significant downside protection through those big market dislocations. What we have here is the Firetrail Absolute Return Fund correlation versus most traditional asset classes. In the orange, we have domestic and global equities, plus or minus 0.1. And in the green, we have domestic and global bonds, plus or minus 0.05. As close as you can get to zero correlation. Now, it's great to have zero correlation, but it's all, when you think about it, for alternatives, at least from our perspective, it's about sort of managing that downside, or getting downside protection. So over the short term, what we have here over the last 7 years, the number of months the ASX 200 was negative. In fact, there was 27 months where the market was negative. The biggest one, clearly, we all remember, which was March 2020, when it was down around 22%. The green bars there is the Firetrail Absolute Return Fund total returns over those particular months after all fees. And yes, we are down on occasions. We are taking risk for clients, so we're not immune to underperformance. But we're down around 30% of the time. But on average, we're up about 1.2% when the market is down. And that's 1.2% above the cash rate, not above a negative equity market return. And right now, that makes sense when you look at our correlation. We've got a slight negative correlation to equity. So when the market is negative, as it is this month, we generally do quite well. So what we're getting is diversification. We're getting low or no correlation. We're getting downside protection over the short term. But what about the long term? That's the key issue, because that's the protection you want. To us, there's been two major market dislocations in the last 15 years. The GFC, we all remember, peak to trough, the ASX 200 was down around 47%. I was managing the Macquarie Market Neutral Fund way back in the day. Same team, same process, same analyst team. We didn't even see the GFC. We just trundled along and delivered around 10% after all fees. But that was a while ago now. What about the most recent dislocation, being COVID? Again, if you look at the history of when the virus was first discovered in December 2019 to when vaccines were becoming a reality in June 2020, the ASX 200 was down around 12.3%. Again, a true-to-label market neutral fund should be immune to those market falls, and ours was, and we delivered around 8.8% above the cash rate. So about a 21% differential over that major dislocation. So this fund's providing low or no correlation, downside protection over the short term, but most importantly, downside protection when you really need it through those major market dislocations. So how do you use it? We've got some clients that just use it as a separate sort of asset class in its own right, but a lot of our clients really do blend it with their equities portfolio. Whether it's 75, 25, 50, 50, it's really up to you guys at the end of the day, our experts. What we have here, just as an example, over the medium term, on the left-hand side, the return after all fees of a 50-50 blend in the green, 50% Firetrail Absolute Return Fund, 50% equities, broadly very similar return, but most importantly, it's all about that journey. That volatility is around 33% lower. So that's over the medium term, but over the longer term, it's effectively the same. In fact, the 50-50 blend is slightly better in terms of returns, plus 50 basis points better. But again, that journey or that volatility is around 28 to 30% lower. So with the blend, you're getting similar returns over the medium to long term, lower risk, around 30% less. But most importantly, you get a much faster recovery when you're digging yourself out of those deep, deep valleys. So COVID, equity market took around 12 months to recover. The 50-50 blend took around 5 months to recover. Through the GFC, it took the equity market nearly 6 years to recover, one of our deepest sort of retracements ever. But it took the 50-50 blend around 2.5 years to recover. So as I said, similar destination, same returns over the medium term, but a much more enjoyable journey. Now, the last thing I want to touch on, because it is important for an absolute return fund, we add a lot of value, but also manage most of our risk with our short book. And shorting, in my view, in the 36 years I've been managing equities, is the best tool that a fund manager can actually have to manage risk. But it gets a bad rap. A lot of in the market saying it doesn't add consistent alpha and it's too risky, so let's steer clear of shorting. So to me, there's the two myths. The first myth is shorting doesn't add consistent value. And I think that's a fair comment if you use one of these three techniques here. And quite a few people in the market still use these techniques. There's always one or two hedge funds or long-short funds that blow up every single year. On the short side, it's always because of one of these three reasons. For 12 years now, we have not touched these 1, 2 or 3 comments. A crowded short, just by quick definition, is just a company where that more than 10% of its shares on issue is shorted in the market. So right now in the Australian market, there's around 13 what we perceive to be crowded shorts. The reason why that is a bad strategy generally, at least in the Australian market, is in the last 6 years, if you actually went overweight those 10 most crowded shorts, you would have, as a group, actually added value 5 out of the last 6 years. So following the crowd or following the popular shorts in the Australian market has not worked for many, many years. Secondly, we steer clear of valuation because, hey, a company just looks expensive. At the end of the day, share prices follow earnings. So if company management can keep delivering or over-delivering in terms of earnings, that share price will continue to rally. And finally, we steer clear of thematics, whether they're actual fads and the like, because the outcomes are incredibly binary and the risk versus return is just not there consistently enough for us. We have enormous opportunities, almost too many opportunities, just focusing on one critical area. We're shorting companies where there's a risk of an earnings downgrade. And that could be anything as simple as an irrational competitor coming to the market, chasing market share and squeezing margins for the whole group. It could be raw material inflation, wage inflation, revenue falling for any reason. If it's a risk of a downgrade, it's an opportunity for us to do further research on. And there's an abundance of these every year, over 170 of these last year. We would research about half of them and we short around 25 to 30. And the hit rate on these is just unbelievable. It's in the high 70s. In fact, the last 11 years, both our time at Firetrail and at Macquarie, this component of fundamental shorting has added value every single year. So it's probably one of the most resilient, consistent strategies we've found at our time at Firetrail and my time at Macquarie. But it is all about getting those earnings downgrades right and share price will follow through time. So I think we have debunked myth number 1. Myth number 2 is shorting is risky. In the wrong hands, yes, it is very risky, but in the right hands, it is the best tool to manage every part of risk within your portfolio. Now, just to set the scene here, this is how we an illustration of how the fund's structured at the moment. The green and the purple there are all our overweight positions, large cap, mid cap, small caps. We have a good mix of value and a good mix of growth. The orange are those fundamental shorts because of earnings downgrades. And the bit in the middle is doing all the heavy lifting for us. It's a risk short algorithm that we created many, many years ago and refined since. And really what it does, it eliminates that net market exposure on a daily basis and if required on an intraday basis. Gets the beta as close as possible to 0 and then reduces all the binary thematic positions, the factor positions, the macro positions, so they're not drivers of the underlying returns of the portfolio. The net result is you have a fund that actually has no correlation to the equity market whatsoever. The other key feature of this algorithm in the middle is that it's very malleable. It automatically expands when there aren't a lot of fundamental shorts, which generally happens post-results. We close them out, recycle them to the next opportunity, and it automatically detracts when there are a lot of fundamental shorts. At the end of the day, we're chasing alpha, so we'll chase these very hard, so that'll automatically contract. So the end result is any day, week, month or year, if we're 171% long, which we are today, we'll be 171% short. Market up 10%, we definitely do not see that. Equity market down 22%, as you saw in March 2020, we don't see that as well. And I think it's this technique that we've developed over the years ensures that probably our fund is probably one of the most true to label market mutual funds, equity market mutual funds in the Aussie market today. So thank you for your time. We touched very briefly on the risks are elevated right across all asset classes. If you are looking to choose an alternative approach, please choose one that has either low or no correlation to equities and other traditional asset classes. Find one that has significant downside protection through market dislocations. And hopefully I've dispelled those myths. Sorry?
Just a question.
Yeah, sure.
You always get the target shorts you're up.
As in borrowing the stock or?
I mean, if you're looking at a certain section of portfolio
Yep.
shorted, will you always get the shorts that you're chasing?
Yeah, so as I said, we will do deep research on 80. We'll short about 25, and we get 18 to 20 of those correct each year, and we turn that book over 3 or 4 times a year. So in summary, broadly we do. When you're shorting stocks, you've got to borrow the underlying shares on issue, if you like, but 99% of the time that's all fully available. The Australian market is very undershorted, it's less than 2%, so the opportunities still are quite abundant. That's it. So we do think now is the time to seriously consider an allocation to alternatives, and hopefully you consider the Firetrail Absolute Return Fund. So thank you.